Hey everyone, welcome back to another action-packed video. Today my webcam isn't working and neither is one of my speakers, so I wanted to apologize for that in advance. But because of the important macro events coming up this week and in the weeks ahead, I wanted to provide market commentary to help give you that additional data. So before we get started, I want to thank YCharts for partnering with me and today's video for providing insightful charts and tables when it comes to investment analysis. So mention Larry Chung for 15% off if you happen to be interested in institutional tools for research. So in today's video, I'm going to give a recap on the Fed minutes, how that's going to set the tone really for the first quarter of this year. And I think first quarter of this year, second quarter of this year, it's probably going to be the most challenging time of 2023. Once we get past the first half of this year, I do think that earnings estimates for the S&P 500 will potentially bottom out, and that will create a much more stable environment in the second half. I'll also walk through one big macro data point about the consumer that I think is really important to continuing to monitor. And then I'll talk about some technical analysis and fundamental commentary across the S&P, a couple of the FANG stocks, China and Tesla, and then I'll end the video with a note on personal finance. If you're new to my channel, make sure to follow me on Instagram and Twitter, where I also post a lot of really insightful and sometimes humorous content, and join my free email list below on Substack, where I share a lot of previews, a lot of exclusive research, and cool stuff that I talk about with my investment community. Now, let's talk about the recently released Fed minutes that came out just a couple days ago. And I wrote an email note to all of my friends on my email list that you guys can read. Links in the description below. But the bottom line, the key takeaway here is that the Fed is not pleased with how monetary conditions are loosening prematurely before they slay inflation. And what they're talking about is they don't envision seeing rate cuts this year, whereas a lot of the buy-side investors on Wall Street, they expect the Fed to cut rates later this year. Now, personally, this is my own view, and of course, everybody else, they have their opinions. I am in the camp where the Fed is likely to cut rates at the tail end of this year. I have a hard time believing that the Fed can keep Fed funds rates at 5% or more for the full year, because I believe that demand destruction is already happening in the auto industry, in the housing industry. It's very hard to purchase new homes for new homeowners when the mortgage rates are near 7% or when car loans are above 8%. I think that makes it a very restrictive environment to buy homes or buy cars. So we'll follow that on the channel throughout the year. Now, in terms of how the market is pricing all of this in terms of valuation, the S&P 500 now trades at 17 times forward earnings, and that's a slight premium from its relative history, but it's definitely not as overvalued as it was last year when the S&P 500 traded as close to 22 to 23 times earnings, as you can see from this chart. Now, something that's important to pay attention to, though, is that in the upcoming weeks, in the upcoming months, there could be cuts to S&P 500 earnings estimates, and that could actually make today's valuation appear cheap when it's actually too expensive. And we'll be covering this on the channel going forward, so make sure to subscribe and turn on the bell. Now, recently, we've gotten some public commentary from Fed officials about how they think about rates. And the theme that we're seeing is that we're going to be in an environment where rates are higher for longer, above 5%. Now, this is a key observation because when rates are above 5%, you're likely going to have mortgage rates around 6.5% or north of that. And then you're also going to have car loan rates above 7-8% for new car buyers. That's an environment where demand will absolutely be softened. So I wouldn't be surprised if later this year we saw the housing component of CPI, we see the auto component of CPI start to demonstrate deflationary kind of characteristics. Now, inside the CPI report, I personally think on a month-to-month basis, one of the most important line items to focus on is the food line item. Yes, all the other components add up to what CPI will be, but it is food that makes up one of the most important line items because that's what puts social stability in place for families across the US. So I think the Fed is really focused on that. And when they talk about how inflation is hurting American families, I think that they're really focused on what are the food prices that are being represented in the food at home and the food away from home line items. Now I want to take a moment to talk about the S&P 500's composition. Compare it from where it was in 2022 and today. Now, this is my wide charts dashboard here, but what I want to show you is this. Today, the technology components of the S&P 500 represents about 22% of the index. This is important to note because back in 2022, especially the first half of 2022, tech made up about 26 to 28%. So that means FANG stocks that had an outsized level of importance in 2022. This year, they're still very important, but they're not as important as they were last year. So for that reason, FANG earnings this quarter, it most likely will move the NASDAQ far more than it will move the S&P 500. Previously, disappointments from Meta, disappointments from Google, that hit the index very hard in 2022. But with Meta now being number 26 or number 27, last time I remember, I don't think a miss from Meta or a miss from Google will be as influential on markets as it was in 2022. Now up next, I wanted to show you one chart that says it all about the US consumer, and this is the personal savings rate, which we can see is now at 2.7% and essentially at multi-decade lows. This is important to know because if inflation doesn't come down later this year, we could see this personal savings rate drop even further, and that could put American families in further debt with credit cards that have APRs that range from 20 to 25%. This is going to be a very dangerous environment indeed for a lot of people, and I really hope the Fed is able to slay inflation later this year. So on top of this, we've got ISMs, and they're declining in sync with the behavior of previous recessions. So a recession is becoming more and more likely. It's just that it hasn't been officially declared. The housing market, it's also expected to be very slow with rates as high. We can see here that existing home sales, building permits, the trend here is clearly downward. The macro trend is very challenging for the housing market, and I don't expect this to turn around until there is a Fed pause. And what we're going to do next is we're going to do some brief technical analysis on several key names across US and China that are of interest. And the reason is earnings season is coming up, and I just wanted to give you a high-level overlay of how certain companies are positioned ahead of earnings season. Now, I do want to note that the charts that I'm about to show you are on the weekly time frame, which means each candle forms after one full week. And the reason I use weekly time frames is that it's used for a longer term assessment of the company's trajectory. A lot of shorter term investors, they can use the 4-hour chart, the 15-minute chart, but for the purposes of this video, I'm going to use the weekly chart, a longer term prognosis. So I've got the S&P 500 E-mini on my screen here, and we can see that we have a very strong macro downtrend on the S&P 500. And it is my opinion that I shared with members that once we get close to that downward macro trend line, that it is an opportunity to reduce exposure. So that is my researched opinion. Of course, if this trend line is broken, we could temporarily see a rally beyond it. But generally speaking, I don't think that this trend line will be easy to break. Now let's talk about the most important component inside the S&P 500, and this is Apple. It has the largest weight in SPX. It also has the largest weight in QQQ. Currently has a forward PE of roughly 20 and change. And the way Apple's share price has moved over the last 12, 18 months, as you can see, is that there have been significant share buybacks in order to boost the share price. And this is coming in conjunction with a slowing market in North America and China. So when we think about Apple's technical picture ahead of the earnings season, I'd say that investors are positioned relatively defensively ahead of earnings. And if EBITDA margins can be maintained, I do think that Apple could potentially be supported if it doesn't fall under recent lows of 125. Now, up next, we have another important component for the S&P and the QQQ, and this is Microsoft. I talked about this in my latest premium Substack note. By the way, if you want previews, exclusive content, make sure to join my email list below. Got great content. I work super hard for the community, and I think that if you do join us, you are going to have a really great time. Let's take a look at Microsoft's weekly chart, which is now definitely in a longer term macro downtrend since the beginning of 2022. It actually started in late 2021 in November. Now, the trend line suggests that unless Microsoft can break above 245 to 250 in the upcoming earnings season, it's very unlikely that Microsoft's uptrend is going to resume for the rest of the year. So Microsoft is a strong company and the valuation is fair. I've talked about that in recent newsletters, but it's important to understand that the longer term trend until the macro situation has turned, even for a great juggernaut like Microsoft, it seems that most bounces are going to fade off that trend line. So that's my commentary on Microsoft. I want to talk about Amazon, a name that I personally like, and I've expressed this opinion to my awesome community. And it's that it actually reached COVID lows just several days ago. And there was a very sharp bounce off those COVID lows of the low 80s region. On top of this, Amazon has formed a very powerful symmetrical pattern. And usually, this is my observation, the market loves symmetry. And so that means that Amazon longer term here, potentially, if we look several years out, is most likely a decent entry. It's just that in 2023, where Amazon is highly correlated with the S&P and highly correlated with the QQQ, of course, there could be further downside. But if you look 1 to 2 years out, I believe that Amazon is attractively priced. Let's talk about Tesla for a moment. And Tesla's vicious sell-off forced me out of some of my positions. The downward momentum was too strong. And even though the shares recovered from those lows back in 107 to the 110 region, my risk management methodology had to get me out of several of my positions, even if that looked like a attractive bottom. So longer term, Tesla is still oversold. I hold Tesla in my retirement account. And the reason I hold Tesla in my retirement account is that retirement accounts are meant for super long-term timeframes. And I'm in the camp that I think Tesla will be successful if you give this company several years. But in the near term, we have their earnings coming up in late January, and we're going to get more commentary about the EV market. So in the meantime, Tesla is heavily contested. I like their long-term outlook. It's just that the short term is very uncertain. But longer term, I do like Tesla. Now let's talk about Alibaba, a name that we've been talking about on my channel for quite some time. And we made a really strong opinion on my channel in fall of 2022 that Alibaba was very attractively priced. Look, I got a lot of pushback on this and I got a lot of skepticism on this, but my friends, I'm not here to debate with you about where the price is going to go in the next week or so, or even the next month or so, I'm here to share my commentary and my research on where I think the company is going long term. And so I follow a process, I follow a methodology. I just want to share my methodology with everyone for thoughtful education. So Alibaba here has broken its longer term downtrend after the 20th Party Congress, massive capitulation, and then subsequent rally. I personally think that Alibaba has somewhat more room to run, but at certain levels, I think that we are approaching danger. If you're interested in that specific type of guidance, make sure to take a look at the previews that I've sent for my investment community members. Overall, the macro environment for China is greatly improving. These are things that we talked about in fall of 2022 that has since materialized. But as we know, no trend is going to stay in place forever. And I will do my best to help you identify when there's opportunity and when there is risk. So my commentary on Alibaba is that longer term, the company still looks good. From an intermediate term perspective, we're approaching levels that I believe merit caution. So the last thing that I want to talk about in this video is this headline that I saw on CNBC, and it's a note on personal finance. And it reads this. It's that building emergency savings is a top financial resolution for 2023. Survey finds. Here's how to get started. And I resonate with this a lot, and I want all of my friends on YouTube to use 2023 as an opportunity to build up savings, because the savings rate in a lot of high yield accounts are yielding 3%, some 3.5%. So this is a year where balancing the opportunity of a high savings rate account and then also picking up shares of great companies at great prices for a long-term investment. I believe 2023 is the year to do this. I think that there will be generational buying opportunities this year. But like I said at the beginning of this video, I think that first quarter, second quarter of this year, that's where the biggest challenges will come. The second half of this year will look a lot better as the Fed grapples with somewhat better inflation data. But overall, I do see a challenging first half of this year, followed by a better second half of this year. And a lot of my friends on YouTube and outside of YouTube, they ask me, what is my preferred brokerage? I use several brokerages. I like Interactive Brokers. I think their resources are great. I think they provide a level of education that a lot of other brokerages don't. You can do fundamental analysis. They also have blogs that talk about how to get into investing if you're a total beginner. And if you enjoyed this, you might enjoy this next video up here on the screen. So with that said, I will see you guys next time.